Oh, but you have to go through income verification. No, you don't. Oh, but you have to tell them where you work. No, you don't. You got to tell them your name? No. Where you live? What do you tell them? Nothing. You put up the collateral, you take out the stablecoin loan, that's it. Be your own bank. So to me, I think banks are obsolete. And this gives you control. Watch the video. So this is a follow-up to an episode I did on debanking. And I'm going to go into essentially how I see it working moving forward, because there was an excellent question. I'll put it up here. And what the gentleman basically said was, hey, how are you going to manage this debanking method with crypto moving forward if you've got a bull market, bear market, bull market, bear market? What happens when things go down? Okay. So I'm not going to get into the entirety of the previous episode, but I'll link it down below. I highly recommend you watch that first. This is what I call crypto for the rest of us. I invest in crypto that I find actually has value and utility 6 days a week. And then in the evenings, usually do H-Bar and Hedera episodes if there's things that are newsworthy. My disclaimer, big dumb animal, don't do what I do. I am fascinated with the idea of debanking. I'm not a big fan of banks. I'm not a big fan of US dollars. I like assets. We all know that the rich hold assets. Over the last couple of years, it's been very obvious that inflation took off. Assets went up in value. Dollars always go down in value because of inflation. So if you're holding gold or silver, even crypto, things like that, they've gone up in value. Okay. So the question was basically this. If we've got these 4-year cycles, and over time, the idea is that volatility will be less and less and less, but like any market, there's volatility. What you're seeing in crypto, like Bitcoin and altcoins, is very similar to what you're seeing just in the regular stock market. You've got your ups, you've got your downs, you've got your corrections, but over time, things go what they call up and to the right. So, if in these 4-year cycles, we've got down cycles, we've got up, right? So we got your bear, things are kind of going down or stagnant, and then we've got your bull when things are going up, and that seems to happen every cycle. So in my example, and I have to say I'm actually doing this, I've taken Ethereum, and I'm going to use nice round numbers. Let's say I've purchased 10 Ethereum, and it cost me $2,000 in a down market. Maybe it was $1,000 or $1,500, doesn't matter. I have $20,000 worth of value. Okay, now what you can do on a platform, if you're not familiar with something like Aave, is you can take out a loan. And I went through how to do it, and I've got a whole episode on actually another channel of mine where I go through the whole debanking. But essentially, you're going to be able to take a certain amount. They call it the loan to value. Ethereum is excellent, in my opinion. It has one of the highest loan to value rates. Not that that matters, because I'm not going to max it out. I'll get to that. But it also, if you're not using it as collateral, you can stake it for a interest rate, for return, rate of return. So first we're going to talk about essentially what am I doing now. So let's say we are in I started doing this earlier. So in that time, it was more of a bear market. So I've got my 10 Ethereum, it has $20,000 worth of value. And I believe loan to value, let's just say they'll let me take out 80%. Okay, so I can take out $16,000. I took out closer to 10, which was more of a 50%. Now, that makes me feel a little more comfortable because there's a liquidation, and I think it changes. I think it's around 83%. So if this value goes down, and I've got my loan is then about 83% of the value of the Ethereum, then they'll start liquidating and selling some of my Ethereum. Now, when I take out a loan, I take out a stable coin. I think it's very important. I go into why. But I take out a stable coin like USDT or USDC, convert it to dollars, and then I take my dollars and I go do what I did. I happen to have bought an old truck for my son. So my plan is that I'm buying it in a bear market. I'm hoping, let's say, that it doubles over time. And if you're not familiar, real quick, you get a loan from the bank, you pay principal and interest every month of payment. Or you go to your broker and you have securities like stock and you get a margin loan. You don't have to pay the principal, you have to pay the interest every month. Now you do have to pay the principal back, but you don't have to because you want to hold on to your assets and you want to hopefully, people typically try to do with margin loans is invest more and leverage themselves. But you can actually pull it out and use it for another purpose. So in that case, you have to pay the interest, and you will over time pay principal, but you're not obligated every month. With a loan through something like this, because it's over collateralized, meaning you've put up essentially more money than you've taken out, you don't have to pay principal or interest. The interest will accrue. You still owe that. Watch the full video if you're more interested. But the idea is this is a much better solution to be your own bank. So if this were to go up to 4,000 and you got 10 of them, well, great. I'm hoping that during this bull run, it'll go up to $40,000. If that happens, I'm going to sell 10,000 worth, and I'm going to pay my loan. Let's say it's more like 10,300, some interest is accrued. And I'm going to pay off the loan, and I'm going to end up with whatever that is, $29,700 worth of Ethereum. Okay? So at this point in time, if I didn't do this, I would have taken $10,000 and bought that car, and then bought 5 Ethereum. But in this case, I'm only going to have to sell for that 2.5 Ethereum. Okay, so in this case, I was going to end up with a car and 5 ETH. But by doing it this way, I'm going to end up with the car and 7.5 ETH. I'm just doing real quick math. I don't want to bore you. But you get the idea. The whole reason you're doing this is because you want to keep your assets, because dollars go down and hopefully assets go up. Okay, that was the example. And the gentleman said, hey, that's great. But what about this guy going down? All of a sudden, I had bear there because I bought it in a bear market and it went up. So that was the bull market example where things go up and you're able to take advantage of that and you're better off in the long run. Bull market, I'm sorry. Now we're in, let's say it's 6 to 12 months from now. All of a sudden things start going down. What are you going to do? Well, what I would have needed to do ideally was pay off that loan when asset prices were high. If I didn't do that, and all of a sudden, I bought my Ethereum at 2,000, it goes up to 4, and because I'm a big dumb animal, I never sold it, and I watch it go down, and maybe now it's 1,500. So now I have $15,000 worth of Ethereum because I have 10 of them, and I didn't sell it because I'm an idiot. I shouldn't say that. If you didn't sell it last time, you're not an idiot. You're just like me, big dumb animal. 15,000, and all of a sudden I had 10, and let's just say they start liquidating, selling some of my Ethereum. Well, I don't want that to happen. So what I do, if you noticed, I mentioned that even though I could take an 80% loan, I wanted to protect myself a little bit, and I said, you know what, I'm going to take a 50% loan. That way, the Ethereum that I have can drop in price fairly substantially, and I won't be liquidated because I didn't take out a huge chunk. I would love it if I only took, let's say, 25 or 20%, but that's what I did. So the idea would be in a bear market, you sold it in the bull, and then you said, wow, like I said, I had 10. I had this Ether, and I had to sell 2.5. Okay? And I was left with 7.5. Well, if I was really thinking, hey, this is the end of the bull market, then what I would have done is sold everything. Right? So I would have had my 10,000 loan paid off, and I would have been left with $30,000. I can just sell it, put it into stable coins, and attempt during the next downturn over time. I'm never going to hit a bottom, but let's say I believe the next downturn is 18 months. Everything comes crashing down. And I say, you know what? I'm going to take this, and over the next 18 months, for 18 months, I'm going to buy Ethereum every month. I'm going to divide this by 18. Let's say I did it for 15, because math is hard. For the next 15 months, so I'm going to invest and buy $2,000 worth, dollar cost averaging, and hopefully I'm going to get, maybe Ethereum's down at $1,000. So in other words, I'm going to try to sell it all out and then buy it all back. Now, as time goes on, if my Ethereum, my debanking strategy, has a significant amount of Ethereum, I actually may not sell it all. I may sell a decent amount, but who knows? You never know what the market's going to do. So I'm probably more inclined to sell, let's say, 2.5 to cover the loan. Maybe I sell a total of 6. Maybe I keep 4. Okay, so I've got 3.5. I sold it at 4,000. That's 12 for it's $14,000 of USDT to hopefully buy some back at a low. I'm sitting on 4 ETH. I never sold it, and I'm able to get, let's say, a 3% yield. So more than likely, I'm going to chop it up into bits because I really don't know what's going to happen. If the Ether never really comes down all that much, or it just spikes up all of a sudden, well, I may be losing out. I may have to buy it back at what I sold it at. Not terrible, right? But I've got other that's still sitting there and it's getting a yield. So the idea being you're going to try to sell when it's high, pay off those loans you've taken, sit on some cash, maybe some ETH, and then buy it back in the down cycle. Rinse and repeat. And to try to protect myself, one way was to take a really low LTV. Now, the other thing that can happen, even during this cycle, I did this once, only because I got a little worried. 24 hours a day, 7 days a week, crypto selling. Some Ethereum came down. You know what I did? When Ethereum dropped down, what did I do? I bought some more Ethereum. And I put it as collateral. So let's say I had 10 Ethereum. You can always add. Now I got 10 plus 1, which is 11. That's why you watch this channel. Math genius. So at any time, you can buy more. Now you might say, okay, well, I don't have money to buy more. Well, personally, I always have, and I think a lot of people do this, what they call their emergency fund. And that's in US dollars. Kids call, truck broke down, needs 4 new tires, needs something else, blah, 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 $2,000. Okay. Air conditioning unit goes out, $8,000. Okay. Whatever. Someone went to the hospital, insurance didn't cover it all, 20% copay, there goes $10,000. Whatever. So we all have those things, but I also use this as, oh no. So if you're worried, the good thing about this is if you've got emergency fund of cash and you see that Ethereum values are coming down, you still think you're in a bull market. It's just one of these downtimes, one of these 10, 20, 30% corrections. And you're concerned that, oh no, I might get called on my Ethereum. They might start liquidating some of it because of that liquidation clause. Well, what you can do is just buy more Ethereum. So, well, that stinks. I got to buy more. Well, if it's coming down in price, when you're buying extra collateral, well, the price has come down. So it's not that bad, right? Because the reason you're buying it is because the price is coming down. And you're buying it when the price is down. So that's not a bad thing. So one way to try to mitigate is to take a low LTV. The other way to try to mitigate is just make sure you've got some cash on hand. So if needed, you can just buy some Ethereum and put it. I remember, I think it was on a Sunday and things had gone down a lot. I just happened to see it and I was like, ooh, what if it goes down a whole bunch more? Well, I don't want to lose my Ethereum. I don't want to be liquidated. So I just bought some and moved it over and I did it on my phone and it must have taken like 5-10 minutes maybe to get it, move it, and then collateralize. You put it up for collateral. So that's the now. We went over that. What happens in the bear? You're trying to sell, you're trying to hold. Either move to stable coin, get some yield, and then if there's extra capital in case there's emergency. Let's talk about the worst case. The worst case is that things drop, you're unable to collateralize, you don't have that extra, and your 10 Ethereum, which were worth 20,000, and let's say you happen to have taken a 16,000, the Ethereum prices drop. Well, remember, these are all over collateralized, meaning you've put up more value. And because you might think, well, I don't like these liquidation clauses. Well, you should consider them your friend. Is that how you spell it? Whatever. That says liquidation. So liquidation clauses are your friend because they're going to keep you from having your Ethereum go to 0 and you still have a loan. That's not going to happen. They're going to liquidate as this drops. They're going to start selling it and paying this off. So you will get this paid off and you may have some left or you may end up with 0, but you're not going to have a loan anymore. So you won't have less than 0, which is always the fear. of making a mistake is that you now have lost your capital and you still have loans. You don't want that. So liquidation is your friend. You've over collateralized. So even the worst case is zero, which means essentially you may have lost some capital, but you took money and you actually paid that money back. So no loans, you're at zero. That's not a horrible worst case. But if you use some of the mitigation strategies, like take a low LTV, have emergency funds to buy some ETH, or maybe swap some other currency, I think you can take care of that. Please do watch the first video. I'll link to it down below about debanking. I think this is the future. It like something even Coinbase now will take your payroll check right in there. Coinbase has debit cards through Visa. MetaMask has MasterCards. So you can hold crypto, spend crypto, collateralize it, get loans from it. You may never have to walk into the bank again. And if I don't have to go to another bank and have them ask me, do I want a checking account, a savings account, a car loan, or a mortgage, it will be a great day. Banks currently offer, in my opinion, no value. All the businesses I've started over my 30, 40 years, I've always had to go to other markets anyway. Venture capitalists, investment banks. A bank would never give me a loan for a business, not a big bank, maybe a small community bank. I never dealt with those. So to me, I think banks are obsolete. And this gives you control. Watch the video because as I pointed out, as long as things are going great, you don't have to make principal or interest payments. And if you want to, you can make a payment of any amount at any time. And it's in your control. You want a loan, you collateralize, you take the loan. Oh, but you have to go through income verification. No, you don't. Oh, but you have to tell them where you work. No, you don't. You got to tell them your name? No. Where you live? What do you tell them? Nothing. You put up the collateral, you take out the stablecoin loan. That's it. Be your own bank. It's an idea. I'm trying it. We're going to see what happens over the next couple years as I'm implementing this, and we'll see whether or not it works. Thank you for watching. Have a great day. Let's hope we can all make generational wealth together with crypto.